So hey everyone, let's understand the different types of legal entity. And the first one, which is very common, is sole proprietorship. So all the small businesses like bakery shop, grocery store, a car wash, all these kind of businesses are sole proprietorship, which means that these kind of business entity are owned and run by a single person. And there is no legal distinction between the owner and the business, which simply means that whatever loan you will take for the business, you have to fulfill that loan. If you are not able to fulfill that loan, then you are bound to put your own asset on risk, which means that whatever assets you have, no matter it's a car or personal money, you have to give it back to the bank if you're not able to pay your loan. So sole proprietorship is something where you are the sole owner or the only owner for that business. So whatever profit or loss you will make, you have to take care of that. So if you look at the features of sole proprietorship, it's very common. I mean, you are the one who is going to receive all the profits from this business. For example, if tomorrow you will open any bakery shop in any XYZ location, you are the one who will get all the profits and you are the one who is going to bear all the losses. So if you take any loan, you should consider the losses as well if happens in your business. Also, there are very less legal compliances. So you just need to submit your ID proof, your business address, and a couple of more documents, and you're good to go, and you can easily open any sole proprietorship business in any part of the world. And the third, which is a downside for sole proprietorship, that is unlimited liabilities, which means that whatever loan, debt, losses you will happens to the business, you are the one who have to bear those losses. And you can also put your personal asset at risk if something goes wrong with this business. And you also can't have a partner in the sole proprietorship. If you really want to have a partner with you, for that we have partnership firm. And partnership firm are different from corporation. Remember, partnership firm is basically a small entity which is started by two people who share common interest and who really want to build a business, and they really want to basically segregate the profit into two parts. And that's why they register themselves as a partnership firm. The basic definition of partnership firm is nothing but when two parties agrees to form a single corporate entity with their mutual interest. So basically these parties will also decide to share their profits. For example, if me and you will start a business tomorrow and you will put 60% of the capital in that business, and if I will put 40% of capital in that business, then we'll also share profits with 60-40% of the ratio. If you look at some features of the partnership firm, I mean, there's always a low cost of formation both in partnership and in sole proprietorship. And also there is a capital contribution ratio. So whatever capital you are going to put in and whatever capital I am also going to put in the business, we also have to share profit in that range only. So if you are putting $100,000 and I am putting $50,000, so obviously you will be getting double the profits which the business is making. And obviously because I'm putting a little less capital. Also, you can also limit the partners from 2 to 20. In some countries, it can varies up to 2 to 50 depending on the different countries to countries. The third common type of legal entity is the limited liability company. Owners are responsible for the amount of equity they have in that business. For example, if you have 10% equity in a business and tomorrow if that business will run into losses, then you also have to pay only 10% of the total debt. That business, the 90% debt in that business, obviously somebody will have the stake of those 90%, that will be paid by some other people. So if you are someone who have a lot of partners or equity shareholders, and like you really want to register as a LLC company, in that situation you only have to pay 10% of the losses, and rest other 90% is paid by the people who have that equity. LLC is a combination of sole proprietorship and corporation. In sole proprietorship, you have unlimited liabilities, which means that you have to put your personal asset at risk. While in corporation, your entity, business entity, and your personal asset are totally different. I mean, and they're separated by a corporate veil. So basically, LLP is a combination of both. So if you own 10% of the business, you have to pay 10% of the debt. If you look at some features of limited liability company, that simply means that there's a corporate veil between your personal asset and your company asset. So if your company took some loan and if it is not able to pay that loan, You just need to pay the loan equal to your equity you hold in the company. So if you hold 10% of the equity, you just need to pay 10% of the complete loan, and that's it. So basically there is a clear differentiation of company asset and personal asset in limited liability company. So now we will jump to a very interesting or the most important legal entity, which is the corporation. Now there are two types of corporation, C corporation and S corporation. But before jumping into that, we first need to understand the difference between the tax structure in LLC and in corporation, or so-called S corporation. So in LLC, whatever profits a owner is making, that owner only need to pay taxes to the government. But in case of S corporation, there's a corporate tax which is paid by those corporation to the government, and there's a personal tax which is paid by the owner, who is basically taking the profits in the form of dividend from the companies. So there is a double taxation in S corporation, but there is a single tax that happens to LLC. So all those big tech giant of United States like Microsoft, Apple, Facebook, all these are basically now S corporation companies. So they have to pay a corporate tax and an income tax of the dividend which all those shareholders are getting. So that's a basic difference between S corporation and LLC in terms of tax structure. So S corporation have double taxation, a corporate tax and an income tax. So corporate tax, those S corporation directly pay to the government, and income tax is paid by the equity shareholders. So if they are getting any sort of profit from S corporation, they basically need to pay that amount of taxes to the government as well in the form of income tax. So now let's understand the most important part, which is corporation. And here we'll understand about the C corporation. So in C corporation, basically a owner, a equity shareholder are taxed separately from the business entity. So in simple situation, the taxation occurs at two levels. At your personal level, it will be income tax. At your professional levels, it will be a corporate tax, or at your entity level, it would be a corporate tax. So a lot of startups which are there in United States are registered under the C corporation, while all the startups in India are registered under the private limited companies. So basically, if you want to start your own business or your own startup in United States, you have to register as a C corporation, while in India, you have to register as private limited companies. And there are different sort of rules at different part of the world. So I advise you guys to at least go through that. So if you look at the features of C corporation, then C corporation have separate owner or shareholder assets which are different from the company's asset. So your personal asset are totally different from the company asset, and these two things are separated using a corporate veil. And also C corporation limit the liabilities of investors. So if investors have put in some amount of money in the business and you also hold equity, if that business will not work out tomorrow, then you do not have to put your own personal asset at risk. Investors have put in some money, they have the equity, they are the one who is going to bear all the losses. Obviously you will also bear some indirect losses, but the majority of the financial losses are bear by the investors, not by you. And that's the very good advantage of C corporation. I mean, your personal asset will always be safe and secure. And in C corporation, it is mandatory to hold an annual general meeting with board of directors, which are basically appointed by different sort of equity shareholders. And there is also a different type of legal entity that is called as a private limited company, which is very important and Indian aspect, but I'm not going to cover that. You can simply read it.